everyone, welcome back to our channel Accountancy. Before we start today's video, make sure to hit that like button and the subscribe button with the bell notification so you never miss any of our videos. Also, if you have any confusion in accounting, feel free to comment down below and we'll try to clear your thoughts. Now on to the video. Today our topic will be capital and revenue expenditure and capital and revenue receipts. And our today's topic will be divided into 8 different parts, which are capitalization, error of principle, capital expenditure, revenue expenditure, comparison of capital and revenue expenditure, joint expenditure, capital income and revenue income. Capitalization. The International Accounting Standard Board defines capitalization as recognizing a cost as an asset. Basically, capitalization is an accounting rule according to which when the cost of an item is capitalized, it is treated as an asset and is reported on the statement of financial position rather than an expense on the statement of comprehensive income. So, the cost is included in the value of an asset and expensed over the useful life of an asset, rather than being expensed in the period the cost was originally incurred. Error of principle. This error occurs due to ignorance of the basic principles of accountancy when an entry is recorded in the wrong type of account. In example, recording capital expenditure as a revenue expenditure. Such type of error is known as error of principle. Now, what happens when error of principle occurs? Well, it is very important to identify the nature of transaction. In example, whether it is a capital or a revenue transaction while recording a transaction in the looks of original entry. Otherwise, it will result in an incorrect computation of depreciation charges and running cost and profit of the business, etc. And ultimately, a disagreement in statement of financial position will have to face. Capital expenditure. Capital expenditure is incurred when a business spends money either to buy non-current assets or add to the value of an existing non-current asset. For example, purchase of furniture, equipment, land, machinery, etc. Moreover, cost incurred on addition or extension of an asset is also capital expenditure. Revenue expenditure. Money spent to run day-to-day operations of the business is known as revenue expenditure. It includes rent expenses, utility expenses, salary expenses, insurance expenses, commission expenses, etc. Capital versus revenue expenditure. For example, buying a new van is capital expenditure, but repairing the existing van is treated as revenue expenditure, and replacing van engine is known as capital expenditure, but repairing van engine is treated as revenue expenditure, and paying legal fees for acquiring the van is known as capital expenditure, but paying petrol cost for van is known as revenue expenditure. Acquiring a new building is called capital expenditure, but doing maintenance of an already existing building is known as revenue expenditure. Painting outside of a new building is called capital expenditure, but 3 years later, repainting the same building is treated as revenue expenditure. 3 years here is used as an example. It could be more or less time. And improving or upgrading machinery is treated as capital expenditure. But machine repairing is treated as revenue expenditure. Joint expenditure. In some cases, cost of one item is divided between capital and revenue expenditure. For example, a business spends $1,500 on an equipment, out of which $1,000 was spent for the improvement of that equipment and $500 was for repairs. So the total amount is split up between capital and revenue expenditure. It is called joint expenditure. And this is an example. This flowchart explains how joint expenditure works. So here, the amount spent on equipment is $1,500, which is divided into capital expenditure and revenue expenditure. Here, $1,000 is spent on the improvement of the equipment, which is recognized as capital expenditure and is reported as an asset in the statement of financial position. On the other hand, $500 is spent on repairing, which is treated as a revenue expenditure and is reported as an expense in the statement of comprehensive income. Such type of transaction is known as joint expenditure. Capital receipts. These are receipts of long-term income, such as money from bank loan or new money invested by the business owner. Revenue receipts. The income arising from day-to-day operations of a business is known as revenue receipts. In example, revenue from sales of goods, commission received, fee received, and rent received, etc. Capital versus revenue receipts. Capital receipts. It has short time effect. It is recurring and regular. It is reported on statement of financial position. But in revenue receipts, it has long-term effect. It is non-recurring and irregular. It is reported on the statement of comprehensive income. Accounting for capital and revenue expenditure / receipts. Capital expenditure are reported as an asset and capital receipts are reported as a liability in the statement of financial position because of their long-term nature. Revenue expenditure are reported as an expense and revenue receipts are reported as an income in the statement of comprehensive income. So guys, that's the end of today's video. I hope you liked it. And remember, sometimes no just means not yet, so never give up on your dreams. If you liked the video, make sure to hit that like button and share the video. Have a nice day.